I'm Richard Horning. I'm part of the venture technology group at S&R Denton. I work in the Silicon Valley office. And one of the things that we do in the Silicon Valley office, and one of the things that I do, is help young companies acquire funding from VCs. I also happen to represent VCs from time to time when they're funding young companies. And the document that describes how this process works is called a term sheet. In fact, in every deal that's done in Silicon Valley, whether it's a funding deal or a license deal or just about any kind of business transaction, it always starts with a short summary of what's supposed to happen, how this transaction is supposed to be architected. In the case of a term sheet, you're involved with considering, the relationship of the founders of the company to the investors, the relationship of the founders to the employees who follow in terms of the stock option plan, the governance of the company, and we're going to see an actual term sheet. I'm going to take you through the term sheet, and then we're going to have a discussion with our distinguished panel about some of the elements of a term sheet and their experience in doing this architecting of the relationship between these various constituencies. But before that, I'm going to ask each of our panelists to introduce each other, and then I'm going to take you through this actual document, which is a typical Silicon Valley term sheet. So, Toby, please introduce yourself to the group.
Yes, Toby Moore with Imprimatur Capital. We have a seed fund in Latvia that we launched a couple of years ago. And I'm from Australia originally, and a few years in London in between, and now I live in Riga.
Hi, I'm Evgeny Kabanov. I'm the founder and CEO of Zero Turnaround, which is one of the most successful startups in Estonia, I guess, at the moment. And that's pretty much it.
Peter.
I'm Peter Cox. I'm a managing associate with S&R Denton in the venture technology group. In the past, I was in-house counsel at 3i, and I continue to act for investors and management teams.
Hi, I'm Ragnar Sais, serial startup entrepreneur, and I have experience to raise money for two different startups. One was raising money in Estonia for local NGOs and government funds, and now I'm working as founder of Pipedrive, and we have now taking money in Silicon Valley, so I have totally different experience and about the term sheets and the investors.
I'm Katarina Metcalf. I'm professor of law and head of the chair of law and technology here at Tallinn University of Technology Law School.
Okay. As I said earlier, this is actually a slightly modified, disguised from a transaction term sheet, which I was involved in architecting. I represented the company in this particular transaction in the negotiations with the investors. And they always start with, oops, go back here. They always start with this thing at the top, which is a warning, don't be fooled, none of this counts. Except for the confidentiality obligations, no one is bound by anything that is written here. All of this can change, the transaction could never happen. And nobody is exposed to any risk or liability if it doesn't happen, other than, and this is where the binding effect comes in, other than the reputation capital of the venture company who signed this term sheet. It's hard, as Ravi was talking about, it's hard to divorce your investor. It's kind of hard for the investor to get the reputation of walking away from lots of term sheets that they've signed because their reputation capital is at risk. So anyway, they always start with this warning. In almost every case for a company that has its origins outside the United States, they're going to be typically required, remember this is a Silicon Valley transaction, typically required to convert themselves into a Delaware holding company through a flip. In some cases, not the case in Estonia, but in some countries in this region that has pretty adverse tax consequences. So you sometimes see transactions where Silicon Valley investors will invest in a foreign domiciled company MySQL and Skype are the two classic examples of this. They're pretty rare, but it does happen. It's usually because there are very bad tax consequences to the founders in flipping it into a Delaware company and trying to pay tax with no money to pay it. So here we have a description of the securities. In this case, it's a Series C preferred. It could be Series A. There's a price. Oops, went too fast. Who the investors are going to be, the amount of money that's going to be raised. Talk about the closing. In this particular case, there may be a first closing or a second closing. The conditions to closing, what will make this transaction close and the money actually change hands, the approval by the board of directors and so on and so forth, due diligence and the like. Here is a topic that gets a lot of discussion, and Ravi mentioned this as well, as did Martin. The pre-money valuation. What is the company worth today? And when you're dealing with a startup, it's really a finger in the wind at the first serious financing, because there's no way to evaluate a company that is sort of pre-revenue or early revenue. How much is it going to be worth? So in this particular case, we had a company that was already existing, and the VCs came up with some metric on how to value the company on oops, here we go. Notice it talks about fully diluted basis. In companies that have a constituency that consists of employees and have set aside the possibility of the employees participating in the growth of the equity of the company, they have these things called stock options, or shares that are reserved for future issuance. When the company is being valued, all of those future to-be issued shares get taken into account, and that's what meant by fully diluted. And then to get the post-money valuation, you just add the pre-money to the new money to the pre-existing valuation and get the next post-money valuation. Purchase price, so on and so forth. It talks about the dilution again, the option pool. Where's the money going to be used? Preemptive rights. In many documents, there will be investors who invested early who will have the right to participate in the next round of funding so that they can maintain their percentage ownership. And those rights have to be either exercised or waived as part of a transaction like this. And then you talk about the rights and preferences of this new class of shareholders. In Silicon Valley, we've worked out this arrangement over many, many years where you have classes of preferred shares. And those shareholders who have these preferred shares, there's conversation about the dividends that they might get when and if declared. But the most important preference that's given to these new investors is the liquidation preference. The liquidation preference comes in when there's a so-called liquidity event, which means, in the parlance of the trade, you get bought by Cisco or Microsoft, or you go public, and somehow there's money on the table, or shares, the equivalent of money on the table. Who gets that money? How does it get divided up? In this particular case, you'll see that the owners of this new class of shares called Series C are going to have a 2x preferential return. 2x the original purchase price. In other words, they put up $8 million. The first $16 million goes to the people who put up this money. In this particular case, it also provides that after the division after they get the $16 million, for 16, they participate with all of the other shareholders in dividing up the remainder. Because these shares are convertible, you have provisions about when the conversion happens. You have provisions for anti-dilution adjustments, which is when there's a future round of financing. How does it affect the ownership percentage of these investors? And the price of their investment gets adjusted. Most preferred shares are not redeemable. In California and the East Coast, there's usually a provision that says after 5 years, the investors have the right to get their money back by forcing the company to buy the shares in. And here we get to another important part, which is the relationship between the founders and the investors at the board of directors level. The board of directors in an American company and most companies around the globe, they manage the entire company. They look after the interests of the shareholders and have fiduciary duties to the shareholders. But how are they elected? In this particular case, two of those directors are appointed by the investor, the lead investor, in this case global as I called it. The third one's independent of the company, and those are elected by the preferred shareholders. We have a representative of the common shareholders, who's the CEO, and then the fifth director, independent of the company. This provision about who are the directors, how they get elected, is heavily negotiated depending on the security that's being offered. Talk about directors' fees, and then we have something called protective provisions. And protective provisions come in at two levels. One is certain transactions that the company would undertake and need to be approved by the board of directors need to have the approval of a majority of the preferred directors. So it might be the case that the protective provision says the company can't borrow more than $100,000 without the approval of a majority of this select group of directors, namely the preferred directors. The company can't issue stock options. It can't do this or that without the approval of the preferred directors. In this particular case, we're talking about the shareholders themselves having protective provisions. The shareholders can change the dynamics of the company. And what circumstances do you need the consent of this special group of shareholders? And just another footnote here. In the United States, in Delaware, and in most states in the United States, this document, the Certificate of Incorporation, is where these special rights are implemented. In other countries of the world, there's an agreement between the company and these round of investors by contract, as opposed to in the corporate document. The liquidity event approval, increasing the number of directors and so on and so forth. And I'll skip down to the end. In this particular case, there was a warrant that was offered to sweeten the package. Who gets information rights, securities regulation, registration rights, so on and so forth. And let's go all the way to the end. So, when you're talking about a term sheet for an investment round, what are the things that everybody who's in this game, that is, people like Rainer and Yevgeny, who are founders of companies, when they're talking with Toby about the investment, what are they going to talk about in this particular dialogue? The type of security that's being offered. Is this a common stock? Is it a preferred stock? Is it a convertible note? Those are classic things in Silicon Valley. They're going to talk about the pre-money valuation. What is the company worth today in the opinion of in this dialogue? What's the percentage of these new shares as a percentage of the fully diluted ownership? Are the investors going to end up with 20% of the company, 25%, 40%, whatever? The price per share, which is a math exercise. Are there going to be any sweeteners that some of the new investors get in preference to other new investors? It might be warrants, it might be stock options. The size of the board, the composition of the board, voting rights. We've seen now in the case of Facebook, certain of the founders can engineer structures where they get 10 votes for every one that everybody else has. That's how Zuckerberg manages to continue to control Facebook. He has a special class of shares that give him 10 votes for every one of the common shareholders. The protective provisions, when is it that you need the permission of the new investors? The size of the option pool, the closing date, and the commitments. Pay-to-play provision, in other words, if this is another later round, do the early investors have to participate in the continuing finance of the company, or are they going to get broken down to common shares? Liquidation preference, the 1X, the 2X business that I talked about, participation rights, information rights, market standoff, registration rights, and so on and so forth. All those things are the subject of the dialogue. So, Let's start with Yevgeny and Ragnar. You guys founded companies. You've raised money. So what were the important things that, in your discussions with the potential financiers, that caused you the most heartburn, the most discussion, the most contention? Let's start with you, Evgeny. The zero turnaround.
Yeah. So I guess we are a little bit special from the point that we raised money from a very good position where we actually didn't need the money. So, which meant that we actually could dictate a lot of the term sheet, which means that actually none of those applied to us. In fact, the investor came in as a usual shareholder with no extra rights or no special requirements. And I guess that was the main point which caused for us the most discussion, is that they wanted a position on the board, they wanted some things, that they usually get, and I got a lot of practice in saying no. I guess the things that we did end up giving is, and that was like not so much in the term sheet, that's like more of a due diligence process, and that was caused a lot of contention, is the actual, more like the actual value of the company. That's always a big point of discussion. So I think it changed 14 times during the discussion, and obviously one of the discussions we in particular had what fully diluted means, because although there's slightly, as it turned out, there was slightly a difference of understanding what is fully diluted between what is understood in continental Europe and what is understood in the USA, because in continental Europe usually we talk about the issued options but not the unissued options, whereas in USA apparently it's just whatever, all the option pool that is potentially available. So that was the biggest things for me.
Okay.
I'll think a bit more while Ragnar answers.
So actually this list remembering me the old times when I was raising money for Estonian company, United Talks. But anyway, I have to say the same thing as Evgeny said. Pipedrive had also been in situation where we don't need money. So this is actual term sheet, one pager. Sorry, this is, and you can't zoom it because I was just printing out and there are actual data. So none of that is here. It's just, only like what's the valuation, what is the, and we have to be like correct. We have been raising only seed money. So you can raise money in Valley with this kind of term sheet up to the 1 million. If you're doing A round, B round, it's totally different world. You will go through serious things. But, so actually this is just, what's the pre-money valuation. All other things are like, that's it. So I think that all this financing documentation has been really changed. If you're Googling, you can find Techstars, YC, other people just putting documents into the internet. Everybody can download it, can change it, and so on. It doesn't mean that you don't need any more lawyer, but everybody in Valley trying to, as far we have experience, trying to simplify the whole process. And the old documentation will always depend in which position you are. And we have been quite lucky because we have been already like doing revenue, now we are in break-even, so it's really giving you a very good position. If you're not in that, and if you're not hot like, I don't know, like Instagram or other things, it's so much different. And as far as I know, it's so much depending where is your potential venture capital based. If it's based in Valley, it's more simple. If it's in East Coast, it's moving a little bit more complicated. And
we actually East Coast.
Yeah, the East Coast. But I think that it's, as far as I know, and I'm speaking with other people and other startup entrepreneurs, it's more and more complicated in Europe and so on. So it's kind of like from Valley to East Coast to Europe and then Estonia. And indeed, if somebody will raise money from investor who has his own law, like in Estonia we have Estonian development funds, and this law already giving many things, but they have to put into the term sheet. So that's really different.
I actually remembered one thing that was a big point of contention is that we declined to establish a US company. So they had to invest into Estonian entity, and that was like such a clusterfuck for them, because like they couldn't even hold the shares directly. They had to have the custodian in the bank, and like it was just understanding the Estonian corporate governance structure and everything was very much fun. We had Bain Capital Ventures, a fairly large company.
But I think that this is very rare. I have never heard nobody who has like even thinking about to invest into Estonian company. I mean like venture capital from Valley or from East Coast, this is the once lifetime experience, I think so.
Well, yeah, Evgeny actually is pointing out one of the dynamics that's part of this process, which is how badly do you need the money? Who has the bargaining power? And in your case, it was obvious that you were able to convince the investors that they're going to invest in the Estonian company if they wanted to be in on the transaction. And I think part of that happened in Skype as well. In your case, Ragnar, you actually flipped the pipe drive into a Delaware parent company with an Estonian subsidiary. And if I'm not mistaken, that was part of a transaction where you were involved in one of the other things that Ravi talked about and Martin mentioned, which is Y Combinator, a Y Combinator-like environment where you went through a process with a very early stage investor with a small amount of capital.
But actually it was in Angelbad, not Y Combinator. Pipedrive was in Angelbad, not in Y Combinator. So these are like similar.
It wasn't Y Combinator, right?
Yeah, it wasn't. So,
right.
But definitely the thing is like this Valley incubators or accelerators, they are putting some kind of like process and some of the form systems.
Right.
And if like Angelbad has invested, then everybody's like taking, okay, they have done all due diligence, everything like that. So they are kind of trusting. Indeed, if you're like from the whatever blank paper,
right.
Nobody has any interest, then it's different situation, absolutely.
Right. Peter, you've had some experience with doing transactions like this in the United Kingdom, where even though we share supposedly a common language,
Not
and
quite.
years ago we shared a common legal system, how are these transactions structured differently than what I've outlined here in terms of the way it's done in Silicon Valley?
There are a great number of similarities. We go through the same process, so we have a term sheet like the one you described. As you rightly said, the words used are different in the UK, but overall the effect is pretty much the same. And the investor will expect to have protective provisions. There will be certain transactions that the company can't do without the investor's consent. They want board representation. They want the ability to get their money back first on any sort of exit. So it's very, very similar to this. And I say it's just really a different language that we use.
English versus American English.
Absolutely. But there are a couple of points which these two gentlemen made me think of. I mean, one is where you have, we're in a strong bargaining position and you have a choice of investor. It should be a process of you looking at the investors as options, as well as them looking at you, because, and as Ravi was saying, it's very much important to get the interests aligned. So when do you want to exit? And what other sort of things are there that you need to have common ground? Because if you're going off in two different directions, it doesn't bode very well for the future of the company. And I think that the second thing that came to mind is that, okay, you're raising funds this time round. If you're fortunate, that will be the first and last time, but you do need to look to the future and think, well, when I need the next round of funding, what do I need to prove to whoever's going to invest to justify beneficial terms? So you always have to have an eye to the future as to what you're looking to raise second or third round.
The continuing relationship with this group of investors as you look forward to the next round of financing.
Yeah.
Professor, one of the things that I've noted in my work with foreign domiciled companies and flipping them into Delaware and comparing that with the way transactions would be structured in a country in this region is sort of the absence of this whole idea of classes of stock. And could you comment from a legal perspective on how these relationships of new investors to existing investors to potential owners of the company in terms of equity participation plans, how these things are generally structured in Estonia that might differ from what we've described here?
Well, first of all, I'd like to answer maybe a little bit differently, but that most of these issues can be agreed upon. This is probably the key point, and as have come up here also already, is that you really have to see what it is you need to determine and then to agree upon that. There's fairly little that is set out in law that has to be done in one way or another. So it is very much up to the parties to agree on the different issues. There are differences between countries indeed, and there's quite a big difference between the US way of doing it. The UK way maybe is a little bit more similar. Now I'm not so much thinking just of the specific issues like different stocks and so, but more of the way you write agreements of all kinds, basically, all through the sort of legal spectrum, because in continental Europe, including Estonia, you generally need to write shorter contracts. We can more rely upon provisions in legislation, so you basically need to write what you really need to have in there, to put it that way. You don't need to repeat everything in a way. So I think that's maybe the main difference, that you need to focus on what it is that you really want this paper to say. You don't need so much of this general language. In this particular case, there's a strong US influence everywhere on the way these things are written. There's a sort of trend going on in trying to simplify it also, but here I think, because in a way, unfortunately, the more complicated US way has had effect on all parts of Europe, and perhaps quite a lot also here, where our legal system is new and recent, so tend to follow this style of doing it.
Are there some things that in Estonian law and that you've referred to where the legislation is very specific and the result is you don't have to repeat it in the contractual agreements themselves that make these special arrangements with a certain class of investor more difficult to achieve? For example, can you create a class of investors or a class of common shareholders who have, let's take Mark Zuckerberg. Could you create a class of what are otherwise common shares that get 10 votes for every one that the other people who have that same class of share have?
I'm afraid I'll give an extremely loyal answer to that, that I'd really have to look at this in great detail, because we also have, as you know, we're part of the European Union, and although there is no unified company law in the European Union, which is quite interesting that even when there's so much unification in other areas, when it comes to company legislation, it's only unified to a certain degree. But there are, and there's actually growing right basically as we speak, more or less, because it's one of the consequences of the financial crisis, which has nothing to do with these issues, but it has led to generally more, say, an overview of the European Union legislation on also corporate governance, for instance. So I can actually not answer that just like okay. This. So if I may just make one small remark that came to mind in your introduction, what was said, that I would say one of the key things to focus on in an agreement, which you should not sort of leave just outside of it, is confidentiality issues. You mentioned it in the beginning of that, and I think confidentiality is so important, especially for startups, and so because if you have some high tech, something that may be of interest for intellectual property protection, then confidentiality can really be the make or break of having that protection. If in some other context it may just be an inconvenience if somebody reveals something or so, but if you're looking to patent something, if somebody has somehow revealed this, it may not meet the novelty requirement which allows you to have it patented at all. So you really need to make sure that anybody that somehow, whether it's an employee or whether it's a member of a board or even an investor, but somebody who gets to know your good idea, how are you protected against them using it, revealing it? So I think here you really need to think about that in an agreement. And
yeah, the idea of confidentiality that's just being spoken about is actually somewhat of an anomaly because it's usually the case, in fact, almost always the case in California and with the professional investors in the United States and with most of the angel investors, is in the absence of a term sheet that has a confidentiality clause, they don't sign confidentiality agreements because they see deals all the time and they don't want to be compromised in their ability to invest in your deal just because they've talked to Yevgeny or Ragnar, who has something very similar. They don't want to be accused of stealing their idea and then investing in you based upon having stolen the idea. So this is one of those rare exceptions where, in the context of negotiating a specific transaction, where money's going to change hands, where due diligence is going to go forward, there is a confidentiality commitment that they make because they're now really getting down to the fine line, which means that the corollary to that is, if you have some technologies that's subject to potential patent protection, you don't want to be talking to the details with your investors before you have a confidentiality agreement in place. But I'd like to turn to Toby, and Toby, we've heard a lot of conversation already today about the relationship aspects of the investors to the company and picking the right investors and the due diligence that the company people, the founders, need to do on the investors, and the fact that they can never divorce you. Can you comment on those dynamics and how, from an investor's standpoint, you have to get comfortable with the founders, the people who are going to drive the equation forward, the team, and they with you? How do those dynamics generally work out, and what's the general process that you go through? And this is not about the details so much as it is the building of this relationship, which then gets converted into some of those details, like board membership and voting rights and protective provisions.
As I said, we have a seed fund in Latvia, but we actually have two parts. There's a seed fund and a venture fund. And we use the seed fund as the first step, and we want to do some sort of proof of concept phase. And so for a seed fund, we can provide up to 100,000 euros. We want it to be a fairly quick process, so say within 4, 5, 6 weeks from initial discussion and then talking about the details of the business idea, the technology behind it, the people in the team, their general vision and direction. To go through then our investment committee and then an investment agreement, and off we go. So we actually don't use a term sheet then for that. But through those discussions, or as you mentioned at the beginning, that the term sheet is a non-binding agreement. However, it's a useful process because it provides structure then in going through the various elements so that both parties then become aware of these are both parties then expectations and goals. This is the key elements that we're discussing. This is the broad agreement of how we're now going to work together for the next period of time. So it's a useful process in that. And so that we go through that process and have that discussion. But rather than doing that through a term sheet and then due diligence and then an investment agreement, we go straight to the investment agreement. So we have a broad discussion to say, this is going to be a proof of concept phase. And for us, then, we're going to provide an amount of money for you, and then let's agree that over this next 10 months, 12 months, you're going to achieve certain things. You're going to build a prototype and then find some test customers who can give some feedback on that prototype. We'll do some patentability search, freedom to operate search, as to see what existing patents or IP is out there already, that there's not going to be any breaching of what you're going to do against the existing IP or existing patents. Then what's the potential for new patents or new types of IP? It could be trademarks or copyright as well. So there's a number of tasks that we agree together over that time period, and then there's a cost budget for that, and then we provide the money for that cost budget as a convertible loan. So as a convertible loan, and often the company either does not yet exist, so they're going to form it next week, or it's just recently formed. So there's no real activity, historical activity that needs to be investigated in terms of legal due diligence or financial due diligence, because in many cases, there's nothing actually there. So then as a convertible loan, we agree that here's what we'd like to see you achieve over the next few months. And this is the budget, these are the people, this is the equipment you need to buy, or the services that you need to buy. And let's say that the period goes for 10 months and everything's achieved, which means that everything's achieved satisfactorily, for which then our loan will convert into a 10% stake. So if it's 100,000 euros for a 10% stake, that means post-money the company is worth €1 million. If it's partly achieved, then we get 20%, because it's not quite as good as being fully achieved, so then the company is worth a bit less. So for our 100,000 we get 20%, which means post-money it's worth 500,000 euros. And then if it's really some things are achieved, but a lot is not achieved, or still there are lots of questions, then we'd get 30% then for the 100,000. So then it's worth a bit over 300,000. So we agree that approach then with the founders, that really the valuation and this conversion rate will be dependent on their performance over that period of time. And that's fixed and agreed at the beginning, so then we can convert and get those shares. Now in the investment agreement in which all of that is described, there are the elements of, yes, once we become a shareholder, then we'd like a seat on the board. In any case, we'll only have ordinary shares so that everyone has the same class of shares to keep it at the same level. And the various other elements that are outlined in a term sheet, but it's just directly in the investment agreement. But to your question on this relationship, we like to see this proof of concept test period as a test of the relationship, so that we actually work together for the next 10, 12 months. So we're not on the board, but we meet regularly. We try and help them find people when they need people, and that could be the test customers, advisors, other sort of experts. And we get to know then how this team performs. So they've got these milestones and deliverables, so do they deliver as they say that they're going to deliver or not? And if not, then what are the issues there? And I think from the other side, they get to know how we work. And so I think it's useful for the relationship building and testing to actually work together for this period of time.
Are the milestones that you spoke about in defining the relationships, are they tied to funding, or are they more expectations and levels of expectation which increase your confidence, but the funding itself for whatever period of time is anticipated is set? In other words, if you commit to $1 million and you have 3 different milestones, they get the $1 million, but you're going to be disappointed if they miss the milestones, as opposed to, we're going to give you $300,000 today. When you meet the milestone, we'll give you another 3, etc. How do you typically do that?
It's the second form, so that we'd split the funding. And again, this is small. It's 100,000 euros. Right. But still, we'd split it. Maybe look at how much money we'll sign the agreement today, and then you get the first money tomorrow. And let's say you need 40,000 euros to cover the next 3 months, and for that you're going to build your prototype. To go from alpha to a beta stage prototype. And for that 3 months you need 40,000. Okay, here's the first tranche. And then that's delivered, and then there's the next tranche and the next tranche. So it's tied to deliverables, so that we can pull back at some stage if it's all going horribly wrong. Okay. And manage our risk exposure that way.
Evgeny, you wanted to make a comment.
Yeah, it sounds like a horrible idea. How are the milestones phrased? Because generally, one of the biggest issues I see with that is that startups are basically, the variability as a startup is enormous. Like startup is, they're in search of the idea, they're in search of the product, they're in search of the market. Like it's not a company, it's not a business, it's a project which searches for the business, right? So what sounds like, for me, like the first reaction to, how you described that you set the milestones and you basically, you change the valuation, which means that you lock in the founders in a specific path and you decrease their variability, which for me is a pretty awful thing.
Yeah, the milestones actually come from the founders. Mm-hmm. So that
it doesn't matter, actually. It doesn't matter if it comes from the founders, because what the founders think today, at this stage, the founders don't necessarily know what they want to do in 6 months. That's the beauty of the startup. You have like a 3 months horizon.
Exactly.
After 3 months, you don't know what happens.
Just to add, I have the same experience where we had like 3 months or 6 months milestones. We was only focused like short term, what we will do, how we can achieve these milestones, because otherwise they will not give us money. But you don't look like big picture. You actually don't like just thinking about, okay, if we are running out of the money after 3 months, what are we doing then? So I think that this milestone thing is, as far I know, is rarely used in Value, because these two things, do you trust founders or not? That's the way it is.
Yeah.
So it's just, the things are moving more complicated, you have to do calculation, other things. Indeed, in some cases, it might work, there are some patent things or what other things, but still, it's kind of the things that, founders have to really focus and to be like, we want to do it in long term, whatever way.
I mean, I'm not even saying about that whether it's beneficial to the investors or beneficial to the founder. I'm saying that this is like bad for everyone. Like investors, you're doing worse for yourself, because you're just locked in the founders. Now the founders, they don't think that they can change it. Now their mindset is set and much narrower than they otherwise would be. And we want, like the main idea, you want the team, they have to be searching. The well-known PayPal, which they changed it right after that. And right after they signed the term sheet, they basically changed their product, they changed their direction, and their PayPal, there's a lot of other companies started from.
Or
PayPal.
Skype, Skype changing also totally what they did.
Yeah, the point that's being discussed here is one of the challenges of a funding commitment where there's an absolute dollar commitment, but the stage of the funding and whether you get the money depends upon meeting the milestone in an industry, startup industry, where the dynamics are such that sitting here today, and again, as Ravi pointed out, you don't know what the future is going to be. And there's a study was done by Randy Komisar, who's a partner at Kleiner Perkins with a professor at University College London, that basically demonstrated that 67% of all of the venture-backed companies who invested based upon the business plan that Ragnar and Evgeny and their teams would have presented to Toby and his colleagues, 67% of those business plans got torn up within 6 months, and they moved to what's called Plan B. Because once they got into the process, they realized that the vision that they had when they were pitching for the money didn't turn out to be a viable strategy, and they had to move to a new strategy. But I would also observe that the savvy investors, and I would count Toby in that crowd, understand this process. And so while there may be a contractual commitment that says no more money, you're basically in a situation where you have to make the case that we found a better way to do what our common objective was, and you should continue to fund us as we pursue Plan B.
Yes, so my point is that I'm not, it's fine to have a plan of record. I just wouldn't put it in the term sheet. I wouldn't put it in it's pretty crazy to put it in a document which is so hard to change, because usually, to change the term sheet, any VC has to go through through the boardroom, so it's like it's not necessarily a simple process, right? And while I agree that having a plan of record is great, having it in that document, it sounds like, if having it in the investment agreement, it sounds like pretty steep.
Okay, so now we've identified for all of you in the audience one of the very controversial provisions that you might find in a term sheet. Peter, in your experience, because you've represented both investors and the portfolio companies or potential portfolio companies, what's the most controversial provisions that you have seen in these kinds of transactions?
There's usually a big discussion around how much of the company the investor is going to take and the price they're going to pay for it. That's usually one of the sort of big areas. But there are also other things such as, depending on what the focus of the investor and whether they are looking to control terms of employment, for example. So what the founders are going to be paid, whether there's going to be a bonus, things like that. And also the rights attaching to the shares. So if there is an exit or there's any other future issue of shares, pricing around that, who gets the money back first, and how a pot of money on an exit, for example, is carved up and shared amongst the shareholders generally.
I actually remembered one very, very important provision which sometimes gets little attention from founders, and that's the strings attached to the next round. So you want to have no strings attached to the next round except the right to participate pro rata. So because that's usually the one the investor will require, but everything else, because basically if you have anything else attached to it, you're selling your future.
But the investors, on the other hand, are going to want to make sure that the money they've put in at round one, they're not going to be diluted, or the second round is going to be at a lower price. I mean, there's a balance to be struck there.
Well, that's where I disagree. The only thing I agree with is the pro rata right of participation. Everything else, basically, because the thing is that you're selling a future because you're not going to have the room to maneuver in the next round, and you might have to take money at conditions or at price which is worse than you should be able to. And
that's why it's worth planning for the second round when you're doing the first round.
Right. This is why you have the provision for the anti-dilution adjustment that's built into this type of document to anticipate the fact of a down round as the second round and the effect on the earlier investors.
Yeah.
But you, for example, don't want to have the first right of participation, which is sometimes a common requirement that that you have the first right to offer money,
right?
Because it will basically hamper your ability to negotiate, because you go to anybody else and the first thing they ask, if we go through all this thing, can they come in and just grab the deal? And the answer is yes.
It helps if you have a strong bargaining position.
Yes, very much so.
Yeah, no, I really wanted to comment maybe more on the milestones thing, that this discussion is a very good illustration of when I said you have to really think what you want in there, because what you really want to avoid is to promise to do something in such a way that it will become a legal obligation, and then you don't want to do that, and then you're in trouble. If you have put it in so that actually the investor can say, well, you said you would do so-and-so, of course, you can always change the contract, but then if there's no interest from the other side, they'll say, well, you said you should do this, and you have a legal obligation to do that. So that's why you really have to think, what do you want to say that you will actually do? So, of course, the bargaining position is the key here, because if you are asked, this is what you have to do or you get no money, then well, that's it. Another thing which was mentioned here in the beginning was that there may be even specific terms set up by, say, organizations, so you have to follow. So, but apart from that, you should really think what do we want to promise, because there may be a legal obligation attached to it, and that's different than just a new negotiation then.
I see my shadow is behind me here, looking at the clock. I know why he's back there. But I'm going to ask you one more question, then we'll open up to a few questions from the audience. You're now being asked by Parliament here in Estonia, and they have to follow your opinion. They've agreed in advance that they're going to follow your advice. What would be the one thing that you would recommend that Estonia adopt that would make the capital raising process for young companies, the angel financing of young companies, more efficient here in Estonia? Is there one thing that you can think of that if Parliament would do this, from a legal standpoint, it would make the whole process and the ability to have people in this audience get more access to funding more efficient?
Well, my answer may be surprising coming from a lawyer, but not to over-regulate, actually. So probably don't do anything.
Don't do anything.
Yeah.
Get out of the way. Get out of the way. Okay, get out of the way.
Wonderful. Let's have maybe two questions from the audience. So who's the first one, quick one, who will get the mic? Is there anybody? There is one. Please. This was first, and then the second one is back there, and then we're done with questions. Wonderful.
I don't see Ravi anymore. He was sitting there. I wanted to ask actually Ravi to comment something that you said about the founders and the milestones. That you said the milestones and the short-term objectives and the long-term objectives, and these don't really support the development of the company and the idea and the startup. And Ravi had this final slide where he said that the best companies are the ones that are found or run by their founders. So the founders know and trust the founders. but I don't see.
But if I could comment. So I mean, we put milestones in because it's useful to provide structure and direction so that everyone understands that we're going in this direction rather than going in this direction. Now, whether the and say then a milestone is to build a prototype. Right. So here's a device, and that you say that you're going to build your new device in 3 months, and then the time goes by, and the device is blue, and then it turns out that the device is red rather than blue. And the reason why we made the device red rather than blue is for these reasons. And that's a discussion that goes through the process. And then we say, yeah, actually that sounds reasonable, and I think that's sensible to make the device red rather than blue. So carry on. So
Yeah,
it's that sort of interaction, and we're providing the money so that we like to have some sort of clarification as to what then the founders are going to do during that time period.
Yeah, but my point is when the founders decide that, we're not going to do a device. Actually, while we were doing the device, we talked to the customers and found out that, devices isn't actually needed, that we can do it all in software.
So it's just
But see, that's the same justification, that then you're testing with customers, you provide feedback, which to us as an investor sounds sensible.
Then why put it in the investor agreement?
Because at the beginning, before then any device exists, then we think it's useful then that all the parties understand what's going to happen in the next time
Sure,
period.
write it down. Why put it in the investor agreement?
I'd make one other observation, and I'll get Ragnar, which is
give you one example that Estonian startup is today in TechCrunch. 300 milligrams is closing the service, and they just already have the new thing, and they just closed it, and the investors are happy with that because they are trusting the guys, and they are already working with no one. I just don't know the name yet, and the thing what they are building, but they just closed like that. They are even using a new name for the new service. That's the way it is.
There actually is, in my observation as a lawyer working with young companies, there is an important role, whether it's a contractual commitment milestone that's tied to further money, or it's simply an expectation kind of milestone, not tied to money, which is founders run the risk of having a very wide scope of where their particular technology can be applied, and by having such a wide scope, they fail to focus on the early good opportunities and narrow their focus to seizing that particular good opportunity today, and instead of being diverted into let's follow 16 opportunities and surely one of them will surface as the best, as opposed to taking a decision with the benefit of investment advice and people who are professionals in that particular segment of the market, and saying we think that these two areas are better for the company to pursue, and that's why we're investing in them. But there's another question.
Exactly.
Less of a question, but more of a comment in defense of the milestone model and Toby. I'm Gerard Casal. I live in Southern California. I've been doing venture investment for about 20 years now, and also been a lawyer. And it's very unusual, just I think, so that the expectation is set. I've almost never heard of a startup that raised capital, didn't need the money. It's very rare, which I think is good, but I wouldn't come out to the venture world with the hope that you're not going to see VCs dictate a little bit more. And I think that what you just described is more of what we kind of term adult supervision that Richard was just going through, which sometimes provides a good framework. It actually can be a healthy thing. It can be kind of a living and breathing thing, and there's a delicate balance there. But very unusual not to get some of that guidance from a VC, and if you're lucky enough not to need the money, I think it's a rare time that you can get that type of scenario.
I just make one closing observation about the guidance from the VCs and not needing the money. In the case of Google, when they got their money from Kleiner, they didn't need it, but they took it. They never spent it, and it was a condition of getting the money that they hire that Larry and Sergey hire a new CEO. Kleiner said, "You boys are not ready to run the company," so they forced them through a process that ended up with Eric Schmidt being hired, which was a good thing for Google and a good thing for Larry and Sergey, but they didn't need the money. So, it's not always the case that you have the complete freedom to do what you want, and you might consider, this whole dynamic of the relationship with the investors and where they can provide value by perhaps forcing you into some hard decisions about certain things related to your business plan that would, again, help sharpen the mind and focus attention on the ability to grow the company. So, anyway.
Well, didn't
I would just comment. Sorry. Yeah, you're totally right that it's not so correct to say that we didn't need the money. So we are actually was looking really, and we're still going around looking like know-how. And usually we're just negotiating that, okay, is this investor having something, is this investor has know-how for us, how we can, because we are looking to investors like team members, how we can have more great team members and how we can achieve and build company bigger and bigger and bigger. But it's just, we have a little bit changed our philosophy, how to raise the money, and we are really has renamed the process also. But yeah, please.
I want to comment on both. For adult supervision, that's what board seats are for. And for the Google, Eric Schmidt eventually had to step down because he basically ran the company into the ground. So.
Hey guys, but didn't you love the panel, the conflict, two sides? Wonderful, thank you very much, guys. This was a great panel. I like it so much, and I see that there are investors, there are these founders, there are stubborn rock stars, and there are the lawyers who smooth everything out. Awesome, awesome. Thank you very much.